What if an AI could see the next stock market crash before anyone else? And what if simply warning the world was enough to cause it?
Imagine if you could know that the stock market was about to crash before it happened, not 5 minutes before, not after the headlines appeared, but days, weeks, or even months in advance. Imagine an artificial intelligence watching every major market in the world, analyzing billions of pieces of financial information, and suddenly sending one warning: a major market crash is coming. Investors panic. Banks react. Governments respond. Billions of dollars begin moving. But then something strange happens. The market starts falling precisely because everyone believes the AI. So here's the question. What if an AI could predict every stock market crash? Would it save the global economy? Would it make investing almost risk-free? Or would its predictions actually make crashes more dangerous? To understand this possibility, we first need to understand why stock market crashes are so difficult to predict. A stock market crash isn't caused by one single event. Sometimes markets fall because of a recession. Sometimes because banks become unstable. Sometimes because investors have borrowed too much money. Sometimes because asset prices become disconnected from reality. Sometimes because of geopolitical events. And sometimes, the trigger is something almost nobody expected. The problem is that financial markets are incredibly complicated systems. Millions of investors are making decisions at the same time. Businesses are changing their strategies. Governments are changing policies. Central banks are changing interest rates. Consumers are changing their spending. Banks are lending and borrowing. Investors are buying and selling. And all of these decisions affect one another. It's like trying to predict the movement of an enormous crowd where every person is reacting to everyone else. Now imagine giving an AI access to this entire system. The AI could analyze stock prices, interest rates, inflation, employment, housing markets, corporate debt, government debt, banking activity, currency movements, commodity prices, consumer spending, corporate earnings, investor sentiment, and thousands of other signals. Instead of looking at one piece of information at a time, the AI could potentially analyze all of them together. And this is where things become interesting. Humans often look for obvious warning signs. An AI could potentially search for combinations of small signals that humans don't notice. Maybe corporate debt is rising. At the same time, consumer spending is weakening. Certain companies are reducing hiring. Bank lending is becoming more cautious. Investors are taking larger risks. Asset valuations are increasing. And market volatility is unusually low. Individually, none of these signals necessarily means a crash is coming. But together, they could form a pattern. An advanced AI might recognize that pattern because it has studied thousands of historical market conditions. It could compare today's economy with previous periods. It could simulate different scenarios. And it could calculate probabilities. For example, it might determine that current conditions resemble several historical periods that eventually ended in major market declines. That wouldn't mean a crash is guaranteed, but it could provide an early warning. And that could be incredibly valuable, because one of the biggest advantages in finance is preparation. If investors know that risk is increasing, they can reduce exposure. Banks can strengthen their balance sheets. Companies can preserve cash. Governments can prepare emergency measures. and ordinary people can avoid making risky financial decisions. In theory, an AI crash warning system could act like a financial weather forecast. Imagine checking the financial equivalent of tomorrow's weather. Instead of seeing a 70% chance of rain, you see a 70% probability of severe market stress. You wouldn't necessarily panic, but you might prepare. And that preparation could reduce the damage. But there's a major problem. Financial markets are not like the weather. If a meteorologist predicts a hurricane, the prediction doesn't cause the hurricane. But if an AI predicts a stock market crash, the prediction itself could change investor behavior. And that's where everything becomes complicated. Imagine an AI becomes incredibly accurate. It predicts market crashes correctly again and again. Investors start trusting it. Eventually, millions of people begin following its warnings. One morning, the AI predicts that the market has a high probability of crashing. Investors receive the warning. Large funds start selling. Banks reduce risk. Individual investors sell their stocks. Other AI systems notice the selling. They begin selling too. Prices fall. The falling prices confirm the original warning. More investors panic. More selling occurs. The AI predicted the crash. But the crash also happened because people believed the AI. The prediction became part of the event. This is one of the most fascinating problems with AI-powered financial forecasting. The moment a prediction becomes widely known, people can react to it, and their reaction can change the future. Imagine a bridge that can hold 10,000 cars. An AI predicts that the bridge will collapse if 10,000 cars cross it. Everyone hears the prediction. Everyone immediately tries to leave the bridge. The bridge never reaches 10,000 cars. The prediction prevented the collapse. Now imagine the same principle in financial markets. An AI predicts a crash. Investors sell early. Prices fall. But because the selling happened gradually, the market avoids a catastrophic collapse. In that scenario, the prediction prevents the crash. But there's another possibility. Investors panic. Everyone sells at once. The market collapses. The prediction causes the crash. So which outcome would happen? It depends on how people respond. And that's why predicting financial markets is fundamentally different from predicting physical events. Human psychology is part of the system. Fear is part of the system. Expectations are part of the system. And expectations can change reality. This creates an enormous challenge for AI. Imagine an AI predicts a recession. Businesses hear the prediction. They reduce investment. Consumers become cautious. Companies stop hiring. Investors reduce spending. The economy slows. The recession becomes more likely. The AI was technically correct, but partly because people believed it. This creates a strange paradox. The better the AI becomes at predicting the economy, the more its predictions could influence the economy. And eventually, the AI might need to consider not only what will happen, but what people will do when they hear what will happen. That is an incredibly difficult problem. Now let's go back to stock market crashes. One of the most famous examples of financial instability occurred in 2008. The global financial crisis wasn't caused by one simple event. It developed through a complicated combination of housing markets, mortgage lending, financial institutions, leverage, complex financial products, and changing investor confidence. Imagine an AI monitoring all of those relationships in real time. Could it have identified the growing risk earlier? Possibly. It could have noticed increasing mortgage risk. It could have analyzed housing prices. It could have tracked bank exposure. It could have studied financial institutions that were becoming increasingly dependent on fragile assets. And it could have connected signals across the financial system. That doesn't mean it would have predicted the exact day of the crisis, but perhaps it could have identified that systemic risk was increasing. And that distinction is important. AI doesn't necessarily need to predict the exact moment of a crash. It may be more useful if it can identify periods when the probability of a crash is unusually high. Think about driving a car. You don't need an AI to tell you exactly when the car will crash. You need it to tell you when you're driving dangerously. Maybe the road is becoming slippery. Maybe your speed is too high. Maybe visibility is decreasing. Maybe another vehicle is approaching. The AI could warn you. Risk is increasing. Financial markets could work the same way. Instead of predicting a specific crash date, AI could continuously calculate financial risk. Low risk, moderate risk, high risk, extreme risk. That might be much more realistic. But even then, there is another problem: false alarms. Imagine an AI warns about a potential crash. Investors sell. The market falls slightly. Then conditions improve. The crash never happens. The AI was wrong. If this happens repeatedly, people stop listening. This is the same problem we face with any warning system. If the alarm goes off too often, people eventually ignore it. So the AI would need to balance sensitivity and accuracy. Warn too early, and nobody listens. Warn too late, and the warning is useless. Warn too often, and people lose confidence. Warn too rarely, and you miss the crisis. This is why financial prediction is so difficult. Now imagine AI systems competing with one another. One AI predicts a crash. Another AI predicts continued growth. A third predicts a mild correction. A fourth predicts a major recession. Which one should investors trust? This could create a new financial marketplace. Instead of investors only comparing companies, they could compare predictions from different AI systems. Some AI models might specialize in macroeconomics. Others might specialize in technical market behavior. Others might focus on corporate fundamentals. Others might focus on investor psychology. And investors could combine these predictions. But eventually, another problem appears. What happens if the AIs start predicting each other? Imagine AI number 1 predicts that AI number 2 will sell. AI number 2 realizes this. It changes its strategy. AI number 1 notices the change. It changes its strategy. Again. Now you have a constantly evolving game between intelligent systems. The market becomes a strategic competition between machines. This could make traditional financial models much less useful, because the market isn't simply responding to economic fundamentals. It is responding to what intelligent systems expect other intelligent systems to do, and that could create incredible complexity. Now let's consider the benefits. If AI could reliably identify financial instability, it could potentially protect ordinary investors. Imagine your investment account automatically warning you, market risk has increased significantly. Instead of making emotional decisions, you receive an objective analysis. The AI could explain why risk is increasing. Maybe valuations are too high. Maybe corporate debt is rising. Maybe interest rates are changing. Maybe economic growth is slowing. Maybe volatility is increasing. You could then decide what to do. This could improve financial education. Instead of simply telling people to buy or sell, AI could explain what's happening. That could help millions of people make more informed decisions. AI could also help governments. Imagine a central bank receiving an early warning that financial instability is increasing. Officials could investigate vulnerable banks. They could monitor liquidity. They could prepare emergency measures. They could communicate with financial institutions. The AI wouldn't necessarily make the final decision. It could function as an early warning system, a financial radar, and that might be one of the most valuable applications. But there is a dangerous alternative. What if governments give the AI too much authority? Imagine an AI system automatically controlling financial policy. It sees rising risk. It immediately changes interest rates. It restricts certain lending activities. It moves government funds. It changes liquidity conditions. These decisions could happen faster than humans can debate them. That might sound efficient, but economic policy affects millions of people. A decision that looks mathematically optimal might have unexpected social consequences. An AI could prioritize financial stability while overlooking human costs. For example, raising interest rates might reduce inflation, but it could also make mortgages more expensive. Businesses might struggle to borrow. Construction could slow. Employment could fall. The economy is not simply a mathematical equation. It is made up of people, and that's why human judgment would still matter. Now let's imagine the most extreme version of this future. An AI becomes so accurate at predicting financial crises that investors around the world depend on it. Banks use it. Governments use it. Hedge funds use it. Retirement funds use it. Insurance companies use it. Millions of individuals use it. The AI becomes a kind of global financial nervous system. Every major institution watches its signals, and then one day, the AI predicts a massive crash. What happens next? If everyone trusts the prediction, trillions of dollars could move almost instantly. Investors sell. Banks reduce lending. Businesses preserve cash. Consumers delay spending. Governments respond. The financial system changes within hours. But here's the paradox. If everyone reacts correctly, the crash might never happen. The AI predicted the crash. Everyone prepared. The conditions changed. The probability disappeared. The prediction became wrong because it was successful. This is called a self-defeating prediction, and it could become one of the biggest challenges of AI-powered forecasting. Sometimes the best prediction is the one that prevents itself. But that creates another question. How should the AI communicate its predictions? Should it tell everyone? Should it only inform governments? Should banks receive the information first? Should large investors have access? Should ordinary citizens receive the same warning? This becomes a question of fairness. If only powerful financial institutions receive AI warnings, they could react before everyone else. That could create a massive information advantage. Imagine a major investment fund knowing that an AI has detected extreme financial risk while ordinary investors know nothing. The fund could reduce its exposure. Then the crash happens. Ordinary investors lose money. The information advantage becomes another source of inequality. So if AI becomes capable of predicting major financial risks, access to those predictions could become incredibly important. The technology might be powerful, but information itself would become a form of power. This is why transparency matters. If AI is going to monitor the global economy, society will need rules about who can access its predictions. And perhaps even more importantly, we need to understand how those predictions are generated. If an AI says, "A major market crash is likely," investors need to know why. What signals did it identify? What assumptions is it making? How confident is it? What could cause the prediction to be wrong? Without that information, people may blindly trust the machine. And blind trust can be dangerous. AI systems are not magical crystal balls. They are prediction systems. They learn from data. They identify patterns. They calculate probabilities. But the future can always surprise them. A completely new event can occur. A war can begin. A pandemic can emerge. A technology can suddenly change an industry. A government can make an unexpected decision. Or millions of people can behave in a way that no historical model predicted. AI can analyze the past. It can monitor the present. It can simulate possible futures. But it cannot guarantee what happens next. And perhaps that's the most important lesson. We shouldn't ask AI to predict the future with absolute certainty. We should ask it to help us understand risk. Imagine a future where every investor has access to an AI financial risk assistant. It doesn't say, "The market will crash tomorrow." Instead, it says, "Several indicators are showing unusually high levels of financial stress." Then it explains why. It shows different scenarios. It calculates probabilities. And it allows humans to make the final decision. That could be far more useful than a simple prediction. Because investing isn't about certainty. It's about managing uncertainty. The best investors don't know exactly what will happen. They prepare for different possibilities. AI could potentially make that preparation much more sophisticated. It could run thousands of simulations. It could test portfolios against recessions, interest rate shocks, inflation, bank failures, market crashes, currency crises, and geopolitical disruptions. Instead of asking, "Will the market crash?" you could ask, "What happens to my portfolio if the market falls 20%? Or 30%? Or 50%? That changes the purpose of AI. Instead of becoming a crystal ball, AI becomes a simulator. And that might be a much safer future. Because you don't need perfect predictions to make better decisions. You just need better preparation. Still, there is one final possibility we need to consider. What if AI becomes so good at forecasting that financial markets fundamentally change? If everyone knows the warning signs of a crash, investors might stop making the same mistakes. Bubbles could become harder to create. Excessive speculation could be detected earlier. Banks could identify risks faster. Governments could respond sooner. Financial crises could become less severe. But markets might also become more unpredictable in a different way. If everyone knows the same information, investors may react simultaneously. And synchronized behavior can create instability. So AI could potentially reduce some forms of risk while creating new ones. That is the paradox. The same technology that could protect the financial system could also destabilize it. And perhaps that's why the future shouldn't involve one AI controlling everything. Instead, we might need many independent systems, different models, different assumptions, different approaches, independent oversight, human decision makers, and strong safeguards. If one system makes a mistake, others can challenge it. If one prediction is wrong, the entire financial system doesn't automatically follow. Diversity can create resilience. The future of financial AI may therefore look less like one giant brain controlling the economy, and more like thousands of intelligent systems constantly checking one another. So, could AI predict every stock market crash? Probably not. No system can guarantee perfect predictions in a world where human behavior, technology, politics, and unexpected events constantly change. But AI could potentially become much better at detecting the conditions that make crashes more likely. It could identify hidden risks, connect signals humans might miss, monitor global markets continuously, and give investors and policymakers something incredibly valuable: time. Time to prepare, time to investigate, time to reduce risk, time to respond. And sometimes, time is the difference between a manageable financial correction and a global crisis. But there is one final question. If an AI warned you that a crash was coming, would you sell? And if everyone else received the same warning, would selling actually cause the crash? That is where the future of AI and finance becomes truly fascinating. Because the better AI becomes at predicting markets, the more its predictions could influence the markets themselves. The machine may not simply predict the future. It could become one of the forces creating it. And when that happens, predicting the market won't be enough. We'll also have to predict how humans react to the prediction. And perhaps that is the ultimate challenge. Not building an AI that can predict the future, but building one that understands the consequences of telling us what it sees. The future of investing may not belong to people who know exactly what will happen. It may belong to people who can use AI to understand what could happen, prepare for it, and remain calm when the future doesn't follow the prediction. Because in financial markets, there is no perfect crystal ball. There is only information, probability, risk, and human behavior. And AI may soon become the most powerful tool we've ever created for understanding all four.